All right. Good morning again, everybody. Happy Wednesday, all you magnificent melon heads. Opening bell go ding. And for the second time today, I hope you are well. It is Inflation Day. And if you are just joining us, if you did not catch my CPI live stream earlier today, markets are ripping higher this morning on the news that the consumer price index came in lower than expected. The number came out just a half hour ago, about an hour ago now. It was 3.0% headline year-over-year inflation. That is lower than the 3.1% that was expected and well below the 4% from last month. Inflation continues to fall, something we've been talking about on this channel. And inflation is going to continue to fall. Dare I say it's going to go negative, and we'll be talking about deflation. Now, keep in mind, inflation going down means prices going up slower. And for most things, prices are still going up, but they're going up a whole heck of a lot slower than they were going up last year, but still going up. But some key areas are negative, namely energy. Elsewhere, we've got core inflation, which strips out food and energy. That came in at 4.8%. That's a beat versus the 5.0% that was expected and well below the 5.3% from last month. So core inflation, better than expected. Couple of key areas. The shelter index. The government is still over-reporting the rental increases. It came in at 7.8% year over year and 0.4% month over month. Now, there is a problem with that because most of the places you can actually go to rent a place, like Zillow, like apartments.com, like realtor.com, most of those places are showing zero growth in rent or even negative growth in rent. In about half of the major metropolitan areas in the United States, the rents are actually starting to go down. No, that doesn't mean your rent is going down. You signed the lease a year ago. I'm talking about people who have places up for rent right now. In about half of the major metropolitan areas, the asking rents are flat to a little bit lower than a year ago. That's very little relief to anybody because rents went up so much last year. And of course, CPI understated that. But the shelter index in CPI is still being overstated, which means CPI has further to fall still. Elsewhere, we have the transportation services index came in at 8.2% or 0.1% month over month. That is well below what we were at last month. We were over 10% last month. Transportation services was one of those core areas that Jerome Powell's been talking about, core non-housing services inflation, that he's wanted to see that come down before the Fed could pivot. Well, we're starting to get that. It is coming down. It came down sharply this month. And energy was still in deep negative territory for the year-over-year number. The energy index was negative 16.7%, but it was positive for the month at 0.6%. So energy still a drag on CPI, but less of a drag than a month ago. But another bright spot here is wages. For the first time in over 2 years, wages are finally positive on an inflation-adjusted basis. We got the jobs report last week. Wages were up 4.4% year over year in last week's jobs report, and now CPI is coming in at 3.0%, which means finally people's salaries have risen at least a little bit more than inflation, at least in this most recent month. Again, little comfort to people because for the last 2 years, the cost of living has risen much faster than wages. So we're still way below where we were a year and a half ago or 2 years ago for the average person's quality of life. But at the very least, that trend has finally flipped and people are at least starting to trend in the right direction. But don't celebrate because the Fed is doing everything they can to prevent that from continuing, i.e. raising interest rates in order to drive unemployment higher to prevent wage spiral inflation. All right. Now that all of inflation is behind us and now that everybody's taking a victory lap and celebrating, now we need to worry about earnings because the whole point of this is to make money. And companies are not making that much money. Companies are making less money. Businesses are making less money. Stores are making less money. Banks are making less money. People are making less money. And even the government is making less money, which means this high that we are on off of this low inflation report, in my opinion, will not last. But before we get into all that, I have to say thank you to the sponsor of today's live stream, the Patriot Gold Group. Guys, whether it's inflation or deflation, the best way to protect yourself from the Keynesian imbeciles who are in control of the global financial system is through the ownership of precious metals like physical gold and silver. And that's why I am happy to recommend the Patriot Gold Group. I'm not just a spokesperson, I'm also a client. I just ordered some gold from them last week. Looking forward to that delivery. And so go to nsfgold.com. Link down below in the description should you feel so inclined, or call 888-988-5401. And as always, be sure to tell them that nobody sent you. With that, let's shrink my big melon of a head. Look what's going on in markets, and markets are loving this CPI print. First things first, the CNN Fear Greed Index at 79, still into extreme greed territory. It's been here for over a month. Danger, Will Robinson, danger. S&P 500, though, this morning, look at that big gap up. Number go up. S&P is up 40 points, or 0.9% at 4,479. The Dow is up 287 points at the open, or 0.84%, 34,549 on the Dow. And look at the NASDAQ leading the way higher, up a full 1.13%, or 155 points, 13,914 on the NASDAQ. And yes, I will definitely be adding to my short position in the NASDAQ today because I think this is going to be short-lived. Now, looking at this, the DXY, what's going on here? The dollar is weaker, but Jack, we just got a low inflation print. Why is the dollar weaker? Because everybody's looking at Jerome Powell. Now, you would think inflation lower, that means stronger dollar, right? No, because right now, interest rates are dropping. People are saying the Fed is going to be less aggressive. There's going to be less rate hikes in the future. Meanwhile, other central banks, namely in Europe, are still raising interest rates. They're still in full-blown tightening mode, which means people are leaving the dollar and buying other things. What are they buying? Well, they're buying euros, they're buying pounds, but they're also buying stocks, they're buying bonds, they're buying commodities. People are dumping dollars and buying everything today. Seems a little counterintuitive, but that's what's going on. The DXY at 101.02, and you can see it in this chart. Now, this is the CME Group's Fed Watch tool. This measures interest rate futures and uses that to handicap what the Fed is going to do at their next meeting. Now, they're still saying a 92.4% likelihood of a 25 basis point rate hike at the next meeting on July 26th. That is unchanged. The Fed is on autopilot. The July hike is happening unless some catastrophe strikes in the next 14 days. But it's what's going on after that has everybody paying attention, because November is when most people considered that a next rate hike would be likely. And the odds of a second rate hike in November are now down to 26.8%. That was over 33% this morning. So based on this low CPI print this morning, people are starting to say less likely chance of another rate hike from the Federal Reserve in November. They're probably going to skip September. That's why I'm not even talking about September. They're doing every other meeting now. But as it stands right now, the market is saying Fed is going to hike one more time and then they're done. All right, so that is why the DXY is heading lower. Now, I just want to add, this is a long-term chart of the DXY, the U.S. dollar. A couple things I want to point to. Obviously, this blue line here, we are at support. We've bounced off this level several times here. This is now the 1, 2, 3, fourth time we've been at this level, and it has held, although we're making lower highs, so we are heading lower. But I just want to point here, look at the RSI. Down here, currently the RSI is, what are we at, about 32 on the DXY. We don't spend much time below this level. You see, guys, we were down here, and that's what happened the last time we were down here. We bounced and we went higher. We never even got anywhere near that level the last time we were in here around 101. So the DXY, technically, it's at support. We'll see if that support holds. The dollar is oversold right now, although with that CPI read that just came in, seems like it could be prone for a breakdown. We'll keep an eye on that one. And you also see that in interest rates right now, yields across the board are lower this morning in the bond market. The 10-year is down 7 basis points at 3.91%. Look at the 2-year, down 14 basis points, 4.75. The biggest mover is the 3-year, down 15 basis points this morning. Meanwhile, the short end, not really moving so much. The 1 month is essentially unchanged, down 1 basis point. So the yield curve is pretty much lower across the board. Remember, bond yields and bond prices are inversely correlated, so this means people are buying bonds. People are dumping dollars. They're buying stocks. They're buying bonds. They're getting out of the reverse repo. That continues to drop. 1.775 in the reverse repo right now. Guys, this is dropping very rapidly ever since the debt ceiling. It continues to drop. Over $300 billion now has been drained from the reverse repo since Janet Yellen went on her borrowing bender. Keep an eye on this. Pretty soon, people are going to start paying attention to this and wondering what happens when it runs out of money in the reverse repo. And people are also buying commodities this morning. Look at gold, up $22 or 1.16%. Again, counterintuitive. Jack, we got lower inflation. Why is gold rallying on lower inflation? Gold, the inflation hedge. Well, that is all about interest rates. Those bond interest rates are heading lower because people are buying bonds. People are getting out of dollars. And bonds are considered competition for gold because bonds have a yield. Gold yields nothing. Well, when interest rates drop, the benefits of owning bonds versus gold are diminished. So people just decide to buy gold. And that's why gold is rallying this morning, up $21 or 1.12%. Silver doing even better. Look at the rip and the shiny, back over $24, up 84 cents or 3.6%. Congratulations to the Silver Bulls. WTI crude up $1. Look at that, 75.92 on West Texas Intermediate. You know what, guys, we're going to have to bring up that chart real quick. I didn't realize the big move was happening in gold today because we are approaching that 200-day moving average on the gold chart. Are we there yet? Not yet. You can see the lines I drew the last time I showed this chart. Watch that 200-day moving average in West Texas Intermediate. Right now, the 200-day moving average is 77.32. The last time we got anywhere near the 200-day moving average, we bounced right off of it and headed sharply lower. And right now, we have a date with that 200 line. We'll see if we can break through it or not. I will not be bullish on oil until I see a break above the 200 line, a retest, and then a move higher from there. But oil looks like it's got an appointment with that 200-day moving average. All right, where were we? We were talking about commodities, the CPI. All right, now let's talk about earnings. Because the whole point of investing is to make money. And when you invest, when you buy a share in a stock or when you buy a company, you're buying a share of the money that they make. So the whole point is to make money. People need to be making money. Businesses need to be making money in order for these investments to pay off. This is very high level, simple stuff. I get it. But earnings is the key, and earnings season starts at the end of this week. Nobody's thinking about earnings right now. They should be. Check this one out in Bloomberg. Goldman breaks its own rule to flag results much worse than rivals. Analysts say they rarely hear so much from bank before the results. That's prompted the sharpest cut to quarterly estimates in years. Goldman Sachs has been trying to warn their shareholders that this quarter is going to suck. It's going to really suck for them. How bad? Well, let's listen to some of this. Rarely has Goldman Sachs Group worked so hard to unimpress. The Wall Street giant has embraced a new game plan to avoid a third straight quarter of disappointing investors on earnings day. Breaking with its own long-standing convention, Goldman executives have been actively downplaying expectations for results that will be disclosed next week. Over the past 6 weeks, Goldman has signaled a 25% slowdown in trading revenue. They've highlighted material markdowns in their real estate book. Watch that commercial real estate bubble, folks. And they said they'll take a hefty write-down as they sell their Green Sky lending platform, a vestige of its botched foray into consumer banking. It's practically a pre-announcement of earnings without calling it, according to Mayo. Goldman is warning, guys, that their earnings are not going to be well. And how bad has it been? Well, analysts expect net income of $1.5 billion in the second quarter, a 48% drop from a year earlier. Remember, guys, the whole point is earnings. The whole point is to make money. Goldman Sachs, one of the biggest investment banks, if not the biggest investment bank in the country, they're saying a 48% decline in earnings for this quarter. So that's why I'm a little doubtful that this rally on the CPI print is really going to have any legs, because bank earnings start up in 2 days. And right now, the indicators are bank earnings won't be very good. That compares with a 19% decline that they anticipate at Morgan Stanley and jumps in Bank of America and JP Morgan Chase. The average estimate for earnings per share at Goldman Sachs is $4.23, with some recent projections below 3%. So the biggest investment bank in the country is working overtime to warn us that this earnings season is not going to be good for them. Don't forget this. We got it yesterday. The United States Red Book Index. This is a not adjusted for inflation same-store sales measure for retailers. All right, this is the same store. How much money did they make a year ago? How much money did they make this year? And it comes out every week, and it compares this week to the same week a year ago. Well, that went negative yesterday, which means Americans are spending less money in stores. Less money nominally, not even adjusted for inflation. If you subtract inflation from this, they're spending a lot less money in stores. So consumers are not spending money. Goldman Sachs is warning that their quarter's going to stink. Retailers are telling us through the Red Book Index that their quarter's going to stink. Well, what else do we have? Check it out. Even the government is making less money. If the government's making less money, that means you're making less money. U.S. Congressional Budget Office June budget estimate just came out. This is from Chris Middleton at Bloomberg. Following the Congressional Budget Office monthly budget projections, receipts fell, led by a $15 billion decline in income and payroll taxes versus June of 2022. Wait a minute, guys. What about all the jobs that were added? What about all the wage increases? What about the strong labor market, the strong jobs market? If everybody is working and if everybody's making more money, why are the taxes on that income going down by $15 billion versus a year ago? These numbers don't add up. Maybe people really aren't making that much money. Maybe the jobs numbers really aren't that good. Oh, and by the way, spending continues to go up. Total spending was at $646 billion for this month versus $550 billion a year ago. So don't think any slowdown in tax income is going to even make the government bat an eyelash at the amount of money they're spending. And another thing you got to worry about this morning, guys, check out this story. What's not being said here is the important thing. Farmers Insurance is leaving its business in Florida after leaving California. We're seeing this trend a lot, guys. Insurance companies, they're ditching California and they're ditching Florida. Why is this going on? I'm seeing articles that are blaming high taxes. Articles are blaming construction costs, environmental laws, climate change, right? Everybody's trying to blame all these reasons. Do you know why this is happening? Because insurance companies are banks. Their business models are virtually identical. And you know what banks do? Right before things get tough, right before things turn south, banks start to de-risk. And insurance companies, i.e. banks, are de-risking. And what are some of the riskiest markets for insurance companies? It's California with their wildfires and Florida with their hurricanes. These companies are getting out of high-risk environments because if there is a large insurance event in one of these areas, they'd be forced to sell some of their assets in order to meet the payouts for these events. And their assets are worth less than they paid for them. The same thing that sank Silicon Valley Bank and Signature Bank and First Republic Bank and Credit Suisse and to a lesser extent Silvergate. Farmers Insurance is getting out of these states because they have lost a ton of money on the assets that they bought because higher interest rates typically sends asset prices lower. These insurance companies are sitting on massive unrealized losses, just like the banks are, and they're trying to reduce their risk, much the same way banks are not lending as much. That's not being said in these articles, but that is what is going on in Florida and California insurance companies. It is a banking crisis. It's not climate change. It's not construction. It's not environmental laws. It's a good old-fashioned bank crisis. Keep your eye on the insurance companies, folks. All right, and with that, I just want to say thank you very much to Mr. Dan Hedin, who's saying, look at the DXY go. Dan, you are so right, brother. Let's look at the DXY because it's moving fast today. Currently down 81 basis points. We have broken through that support level. We'll see if it rallies today and recovers that. But a breakdown in the DXY would be, all other things being equal, that would be bullish asset prices. Weaker dollar, asset prices higher. And right now, that is holding true today. But again, the DXY, it's looking oversold here. The RSI is heading low, and it is right around support. So we'll see if it bounces. Thank you very much, Dan, sir. I appreciate the super chat and the support of the channel. And looking forward to talking to you later today on our Patreon Zoom call, which is at 5 p.m. Eastern Time. We get together once a week on Patreon to talk about everything happening in the market. I'm sure everybody will have a lot of questions about CPI for that call today. Link down below should you feel so inclined. Also want to say thank you very much to Patriot Gold for sponsoring this live stream. Thank you to all you fine people for giving me your time this morning to listen to my ramblings on all things finance. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.